Hi, welcome to this video today, which is all about Forex money making tips. And in terms of today's tip, it's essential that traders learn it before they start trading, in my view, but most don't. What I want to be looking at today is power laws and how they relate to Forex trading, i.e., the law of returns. Now, in terms of every professional trader, they know how the law of returns works and they leverage it to their advantage. Most beginners have no idea what it is before they come in the market, so when they discover what it is, they react to it in the wrong way and lose their money. Now, in relation to explaining the law of returns, we're making reference to a fantastic book by a guy called Ken Grant. He's a hedge fund manager, and he wrote an excellent book called Trading Risk. And in that book, he outlines the importance of the law and also some other great tips in terms of improving your money management, maximizing profits on your open trades. And he's consulted a lot of the great traders such as Tudor Jones and Steve Cohn. Book well worth a read. Now, in terms of the law of returns, I very often explain it to traders, and they do not believe, many of them, that it's true. It is true. It's been scientifically proven. You need to understand how it works and how to leverage it to your advantage. So what we're going to do now is look at just how to do it correctly. So I've written up some points on a storyboard, so let's go to them and go through them. Right, so just the first of two storyboards. This one I'm going to summarize what power laws are, the law of profit and loss in trading. And then we're going to do another storyboard, look at how to maximize the law and avoid the key errors that most traders are going to make in relation to it. Now, in simple terms, what is the definition of a power law? Well, in mathematics, it's defined as a relationship between two quantities such that one is proportional to the fixed power of the other. They can be seen in the natural world, in solar flares, intensity of earthquakes, brush fire damage, etc. They also exist in the human world. And the best way to describe it simply, I think, is the Pareto principle, which a lot of people here might be familiar with. He was around, Pareto in 17th century Italy, and he noted in his city that 80% of the land was owned by 20% of the population. He then found this ratio occurred in other cities as well. He also found it applied to income distribution, so 80% of the population of Italy held 20% of the wealth, and he found it in other areas. The Pareto principle is very popular today. There's many books on it, and it's frequently taught in business. When I used to be in business sales, I went to a lecture on it where they just rammed home to you that 80% of your profits or sales are going to come from 20% of your client base, which is true. It's a rule of thumb, okay? It's worth reading up on the Pareto principle. There's a great book by a guy called Richard Koch, Kock. It's the classic book on the Pareto principle. Anyway, in terms of in Forex markets or trading generally, okay, there is a fixed ratio. And Ken Grant, in a study of very successful fund managers, noted it. For every account in our sample, the top 10% of all transactions ranked by profitability accounted for 100% more of the P&L, profit and loss, for the account. The pattern repeated itself consistently across trading styles, asset classes, instrument classes, and market conditions. So what you've got effectively is 10% trades really giving you your big profits, or the fund managers making their big profits from those 10%. So what about the other 90%? Well, they're going to be minor profits or losses. Now, Grant makes a key point, which we'll look at next, which is the main danger in being aware of this concept is the tendency to misinterpret its implications, which most traders do. So let's look at the key errors to avoid and how to maximize the law for profit. Right, let's have a look at how novice traders react to the 90-10 ratio. Now, most have not done their homework, they're unaware of it, so they're going to assume that it's a problem and they can correct it, which is mostly due to myths online. In terms of getting the right education, most Forex traders don't. If you look on YouTube, for example, you're going to find a huge amount of videos that say make 100 pips a day with your strategy. trade with a 95% win rate, make 20% a week or a month or whatever it is. It's myths or lies, but it's convincing to a lot of beginners, and that is why they feel they can correct the 90-10 ratio. So what do? They'll constantly change strategies, hopping from one to another, or they'll tweak their strategies. Common tweak is, let the losers have a little bit more room so don't get stopped out so often. That's not a good idea. I think main problem that traders have is they take the profits in too quickly. Any profit will do, no matter how small, so long as it's a profit. They feel good. They want to get a high win rate. But it's like Bill Eckhart said, one of the great traders of all time. If you focus on a high win rate, that is totally going to destroy your profit potential, because all you're going to end up with is small profits that never cover your losses. It's a basic, obvious point, I think, but most traders, just so tempted, take profits too early. They also decide to be patient, but in the wrong way. So let's say they have a string of losing trades. They think, you know what, I'm not going to trade much at all. I'm just going to wait for that big trade, the surefire trade, and hit it big. That's being patient in the wrong way. Any trade can go wrong. Okay. Now, pro traders, no, you need the 90% of small losers, small winners that basically are going to cancel themselves out to get the chance of the 10%. You don't want to fight the law. You need to basically go with it. Okay. Now, you should have patience to wait for just good trades. Okay. So they must fit your strategy rules, and then you can go for the trade. But never think that, one trade is better than another. You're trading a sequence. Okay. So any trade can go wrong. You always need to keep that in mind. But in terms of the 90 being needed for the 10, a simple analogy would be with sport. I'm just going to use Babe Ruth, for example. Now, Babe Ruth, he spent 80% of his time getting, I don't know what they call it in baseball, sent off the field because he'd been taken out or whatever. But the 20% of the time that he got the big hit that he wanted was enough. Okay? He once said, I don't want to go for those dinky singles. That's pointless. I need the big hits. And he didn't get them the majority of the time. He knew he had to step up to the plate. You got to trade. Okay? So as long as the trades are within your rule framework, you go for them and you let your edge work longer term. Individual trades do not matter. Okay, it's the long term. Now, pro traders structure their trades in a way where the potential profit far exceeds the maximum loss. That's an obvious point many people might be saying, but most traders don't do it. What you have to do is focus on expected payout v risk. That's totally different to probability of trades. Let me give you an example. When we're trading, we're going aggressively for trend changes. Okay, so if you've got trend in motion, the probability, you could say, is in favour of the trend most of the time, of continuation. It doesn't matter. We're going to get stopped out a lot of times, but once we get the turn, we're looking for some of those trades that turn into really big winners. Of course, they all don't. Some go a little way and come back or whatever, but we will get big trades. So they're going to be, for us, 500, 1,000 pips or more. We're not going to get that many, but we're going to get enough. Okay. You're really focused on process over outcome. The outcome of individual trades doesn't matter. Okay. So you focus on the process, you stay disciplined, and if you've got a strategy with an edge, it will work longer term for you. Okay. Now, I will say, if you've got a strategy with an edge, you need to research it yourself, total confidence in the logic, understand why it's going to work longer term. Most traders don't do that. They just pick a strategy and hope for the best. Right. Now, in terms of point D, Bruce Kovler, one of the great traders of all time, makes a fantastic quote, in my view, which most traders could learn from. He noted, Michael Marcus, another great trader, taught me one thing that is absolutely critical. You have to be willing to make mistakes regularly. He taught me about making your best judgment being wrong, making your next best judgment being wrong, making your third best judgment, and then doubling your money. Okay? And, experienced traders will relate to this. You do very often go a long time with not much going on with your strategy, just small profits, small losses. Then you hit that big trade. And Ed Sakota, another great trader of all time, once made the point, one good trade pays for them all. I.e., one good trade will pay for a lot of losers or kind of nothing trades. Now, novices or beginners do not embrace the concept of 90-10, okay, which leads, ironically, to 90-10 in terms of 90% of traders lose, just 10% win. So, having a grasp of the 90-10 ratio is the real kind of secret of Forex trading success, and you can build a strategy to maximize your profits, okay? Keeping the ratio in mind and not trying to fight it. It's there, okay? So go with it. Now, in terms of Ken Grunt, his book, Trading Risks, is absolutely excellent. A lot of other great points in the book, as I noted in my introduction. So go and get that. I hope you enjoyed this video as well. Thank you for watching me as usual. Take care. Have a good day.